And I was bringing the viewers into my own inner workings here, Mimi, when I was saying interesting, when you said this is the most neutral we've been in 10 years. That's kind of an interesting statement to make. It's like we're the most bullish, we're the most bearish. You're the most neutral you've been in 10 years. And the regime has changed over from what people used to do, what's working. Now it's an entirely new strategy that you've come up with here? A neutral one.
The neutral strategy?
Yeah.
Well, let's take it into context. The past 10 years, the Fed, for the most of that time, has been suppressing bond yields massively. And as a result, there was there is no alternative. Equity valuations got ridiculously high, especially in tech. So here we are a year later, and we really like diversified portfolios across the board. We came into the year overweight commodities, underweight fixed income, underweight equities, and we've really squared up across the board due to improved valuations and the longer term outlook. Despite the recent volatility, we think is very solid.
All of your forecasts are probabilities, percentages, things like that. And so at this point, what, a 30% probability that we go down another 10% and test the lows?
Yeah, I think that's totally reasonable. I mean, especially in the context of overall equity volatility, we think that's a reasonable outcome. We think we're range bound here, 3,650 to 4,300. That sort of range in the S&P, and in bond yields about 3.25 to 4% in 10-year notes.
You feel better about things, don't you, Kara, or not? Am I reading that wrong? You think we've gotten some of the inflation behind us? We may have some earnings issues now, but does 2023 look as bad as 2022 to you?
Well, we think we're turning the chapter a bit in this bear market. Up until now, the focus has been very much on inflation. But now we've gotten some decent numbers suggesting that the Fed is beginning to win the war. So, better CPI report, container rates are lower, wages are even starting to show some softness. So that's all good news. The challenge is that the market hasn't yet contended with this lower earnings environment for next year. They're still expecting about 5% growth. Profit margins are up near historic highs. So all of this collateral damage from the cumulative tightening monetary policy has not yet made its way into numbers. So with that, we're still expecting some weakness into next year, particularly with valuations that are about at average levels. Not terribly attractive, but not terribly expensive either. So similarly, we feel like things are about neutral here. You're not being paid to take a lot of risk, at least on the equity side.
And that is the first 6 months or for most of 2023?
So we anticipated recession in the first half of next year. So that would suggest that by the second half of the year, assuming it's not too deep a recession, that we could start to see some rebound in markets. But right now, the Fed is still a little optimistic. All those earnings estimates have been pushed into the back half of the year. So you need to see some of that, excitement about the back half of the year actually come down in order to work through it and be more positive going forward.
Do you think the Fed, in the back of its mind, is getting close to feeling neutral about things? Still talking tough, but you are seeing some of the effects, even in the labor market, because we're hearing about a lot of layoffs. Eventually, those will add up. Do you think that the Fed is getting close in their own mind to where they need to be, but still talking tough, Karen?
I think they need to see more work done on the labor side. So we've just started to see the first bit of evidence that wages are slowing. All these announcements about layoffs are actually not big enough yet to make it into the broad numbers. So the Fed and the risk to wages is that they're very hard to bring down and to slow. So the Fed is more likely to overshoot on labor market weakness than let it run for longer. So they're going to have to see more weakness in the numbers in the first half of the year in order to really back off. But the early indications are positive.